Hi, this is ETF.com's Exchange Traded Fridays podcast, a weekly podcast covering developments in the ETF industry. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com.
And I'm Jeff Benjamin, Wealth Management Editor here at ETF.com.
This week, we're talking with Troy Cates, co-founder, managing partner, and portfolio manager at NEOS.
Troy, can you tell us a little bit about your background and what caused you to launch, or I guess co-found NEOS?
Sure. Well, first, thanks for having me today. So NEOS is a global asset manager where we utilize quantitative approaches to deliver yield enhancement and risk mitigated investment solutions. We have been part of a team of people that have launched a number of ETFs over the past decade or so. And I myself have been in the business over 25 years, early on focusing on equities and option trading. And when we launched our first asset management firm and brought out some of the early option-based ETFs over a decade ago, my co-founding partner Garrett and I really wanted to focus on the option-based ETF space. And as that's grown over the past number of years, we really wanted to get back into the space and founded NEOS just over 2 years ago and launched our first 3 ETFs in August of 22. But it's a space we've always been passionate about. How do you take an option portfolio and use it to enhance either an equity or fixed income or a cash portfolio to bring out a desired tax-efficient yield that an end shareholder could then have in their portfolio and help them expand on what they're trying to do in their portfolios.
Troy, you touched on the enormous growth of options-based strategies. We've been seeing a proliferation of ETFs that focus on these strategies. Why has there been so much growth in this space over the past year or two?
Sure. So I think I look back and when Garrett and I first launched some of these early option-based ETFs over a decade ago, the question was not so much why an option-based income ETF. It was more around what's an ETF and why would you ever put an option in it? So as the space has grown in general, those are passively managed buy right strategies. As the space has grown and we've seen more of an active approach to ETF management in general, that's lent itself to more of people reaching out to more of, they call it alternative spaces with options and other products. And as option income, I think, becomes more and more important for the end shareholder, we're looking at people all across the age spectrum that want to bring in income or have income producing investments and then also have tax efficient investments. I think we've seen this really big growth in the space. And even as 3 or 4 years ago, the space was still pretty small. And now it's grown to where there's, I believe, over 400 option-based ETFs that are in the marketplace now. And I think a lot of them, when we talk to clients and advisors, we say, listen, there's a lot out there now. There's more coming out every day. I think as the space grows, there's room for a lot of other innovations and other providers to come into the space. But I think the end client needs to do their homework. They need to look at some of these products and say, is this yield, can it be supported by the product that's being put out? What is the tax efficiency? What does it mean getting this much of a yield versus this much of a total return? I think it's very important for everybody to do their homework and understand what they're getting because all option strategies are not created equally. And I think that's really important when anybody's doing their due diligence on what kind of investment they want to make. So just to get back to your question, I think the space continues to grow because there's people searching for income, even with yields doing on the short end what they're doing now after the Fed has been raising rates and potentially looking to cut rates later this year going into 2025. I think sourcing income from other areas of the market, like an options market, is critical for a lot of clients.
And I want to talk more about the points of differentiation that various options ETFs can have, Troy. But before we get into that, you mentioned obviously interest rates are a bit higher today than they were a few years ago. Is there anything about the current macroeconomic landscape or just investor sentiment in general that is causing these ETFs to grow in popularity? I ask that because whenever I think about covered call ETFs and things like that, I think of them as giving up some upside in return for yield. So does that mean investors are kind of nervous about the stock market? They don't see as much upside. Maybe they think stocks are going to be range bound. What do you think?
I think, of course, if you're thinking traditionally in those covered call strategies, that you're going to give up some form of upside in return for some form of a payment now or a yield distribution. That's definitely true. We look at it a little differently at Neos. We want to make sure that not only are we providing those that high monthly income in a tax efficient manner, but we're also helping the portfolio participate in the upside of the underlying index. So if you look at any of our ETFs that use these covered call strategies, we want to make sure we're participating with the movement higher. Now, yes, there's always a point where you are essentially capped out and can't participate any higher. So you are selling away some of your upside when you're selling those, out of the money calls in, say, the S&P 500 or the NASDAQ 100 or the Russell 2000. You're definitely selling away some of your upside. But I think overall, people are looking, to different avenues of where they could source income. And the option market has always been a place where traditionally larger institutional investors have sourced income from. And I think as the growth of ETFs in general, I think it's become more readily available for everybody to be able to source income from the options market through ETFs like ours.
That's great. So, Troy, you've touched on some of the factors that investors should look at when it comes to analyzing these funds, yields and things like that. There's obviously fees and the price appreciation potential as well. What are the factors that investors should be looking at?
I think it's important, a lot of investors might use different data services, whether it's through their online brokerage account or through just different internet service providers, to figure out what an ETF is doing. And I think what you always need to look at is look at the total return of the ETF. Sometimes on these websites, you might just get a price return and say, well, this doesn't make sense. But you have to factor in the total return, which includes not only the price appreciation, but the distributions paid out during that time period that you're looking at. I think it's really important for then a client to dive in and say, okay, this did this total return. What was the distribution for that year? And more importantly, how tax efficient is that distribution? Because like I said earlier, all option strategies are not created equally. We try wherever we can to use index options in our strategies. That gives you a different IRS tax classification. It gives you their 1256 contracts, which gives you a 60% long-term, 40% short-term tax split. So that helps the end client when they get that 1099 at the end of the year, looking at what their total tax bill is on their distributions they received. I think it's important for them to dig in not only on the total return, the price return, looking at the distributions, but then how tax efficient are those distributions during the year.
Hey, Troy, I want to ask you a little bit about the kind of the appetite for these strategies. I mean, they're all over the place. We see them everywhere. The idea of capping the upside in exchange for some downside protection, to me, kind of feels like insurance. And whenever I think of insurance, I always think it sort of favors the house. I mean, are financial advisors going after this stuff? Or is it more of a product looking for a home, or what do you see? And are these kind of products that might be attractive right now with the equity markets at lofty levels?
I think it's a combination. I think when you look at it, we talk to advisors every day, and yes, they are buying these products because they have, whether it's a yield or total return or diversification or to lower volatility, they have a mandate from their clients to get certain, yields, like I said, or maybe it's just to lower the volatility of that client's portfolio, or maybe this client is getting to an age where they need the income on a monthly basis. So we're hearing it across the board. But if you think about the growth in the space, I mean, the largest active ETF out there is an option-based ETF and providing monthly income. So the space has grown tremendously. So the advisor adoption And also the end client, call it retail adoption, has been huge over the past, say, 3 years, if you look at the growth in the space. And then, of course, like you mentioned earlier, the growth in the number of funds coming out. And again, it goes back to, because there's so many funds coming out and people saying, all right, I want, say, a NASDAQ version of some sort of covered call, and they pull up a list and there's a lot of them and they're growing on a monthly basis. I think that's when the advisor or the end client really needs to dive in and say, what does this mean to me? What can I get out of this product? How tax efficient is it? How much yield can I make off of this product? But can I still participate in the equity markets? And that's an important part, I think. A lot of the older passively managed buy right indexes were, call them at the money buy rights, whereas as the market has grown, as we discussed earlier, I think it's at a place now where supporting something that could capture, a good portion of the upside of the underlying reference index while still providing that high monthly income is really important to the advisors now.
To be clear, these are technically defined as active strategies, but they're always based on an underlying passive index, right?
So yes, so when you're talking about the NEOS ETF lineup, all of our
Mm-hmm.
ETFs are active. So if you look at, say, our NASDAQ 100 high income ETF, which is QQQI, we are owning a basket of all 100 plus names of the NASDAQ 100. And from an equity standpoint, we're just tracking the NASDAQ 100 index. But when you add in our option overlay on top of that, which is a laddered covered call strategy, that's utilizing NASDAQ 100 index options. So those NDX index options, we're utilizing those and rolling those on a monthly basis. And we have a rules-based systematic approach that we follow to bring in income, distribute that income, but also let the portfolio, the underlying equities, appreciate. We're selling calls out of the money, for example, and our model does not necessarily need to write on, say, 100% of the notional of the portfolio. So there's a portion of the portfolio that's allowed to appreciate without those short calls on top of it.
But it is based on a passive index. They're always based on passive indexes, right? The activity makes it active, the buying and selling of options, right?
So yes, when the activity, since our ETFs are not as a whole tracking a specific index,
Mm-hmm.
yes, the activity of the option strategy is not tracking an index. That is the active component of it.
Right.
Other providers do different things, but for us, the active component of it is the option strategy on top of the passive index.
If you're a financial advisor and you want to hear the latest insights and strategies in portfolio management, make sure to also subscribe to Advisor Upside, available wherever you get your podcast. Tell us about your lineup. I know you touched on it a little bit, but what do you guys have? Why should people consider investing with EOS right now?
Sure. So we launched our first 3 ETFs in August of 22. Those 3 ETFs are CSHI, which is our enhanced income 1 to 3 month T-bill ETF. That's an ETF which has a basket of 1 to 3 month T-bills and then uses a SPX index put spread overlay on top of it to bring in an additional 1 to 1.5% a year on top of whatever your T-bills are doing. So when we launched the product, we're probably getting 2.25 back in August of 22 on a 90-day T-bill, whereas now we're getting over 5%. Obviously, we all know what the Fed's done during that time frame, but when we launched the product, with a 2.25 T-bill, we were getting, call it a total yield of 3.5 because we were bringing in that extra option income. Now we're looking at 5.5, 6 with the option income on top of the T-bills. So it's a really nice ultra short duration product that's really grown nicely since August of 22. Our other fixed income product is BNDI. That's our enhanced income aggregate bond ETF. This was a product we wanted to add an SPX index put spread overlay on top of core ag and core bond portfolio. So we're long 2 ETFs to get that exposure. We're long AGG and BND. And then we have this option overlay to give you an extra 2 to 2.5% over whatever that aggregate bond portfolio is doing while keeping your standard deed the same, which is very important to us. So we're always managing towards risk before trying to take outside risk to bring in more yield. That's where we kind of focus everything on. And then our third ETF that we launched back in August of 22 is SPYI. So that's our NEOS S&P 500 High Income ETF. That's our largest ETF to date, with just over 1.5 billion, and has had tremendous growth, not only from an AUM standpoint, but really nice performance over the past almost 2 years now. This is, think of the ETF as a basket of S&P 500 stocks that's just trying to track the S&P 500 in that equity portfolio. And then with a SPX index call strategy on top of it. So it's a laddered short call strategy, so a buy right strategy, where on a monthly basis, we're rolling these SPX index options to bring in income. And as I mentioned earlier, the model does not have to write on 100% of the notional, which is nice. It leaves a portion of the portfolio uncapped depending on where volatility is for the month. And then one of our newer ETFs that we launched in January, the end of January of this year, is our NEOS NASDAQ 100 High Income ETF, QQQI. Very similar to how SPYI is run, just substituting that S&P 500 exposure for NASDAQ 100. So long all NASDAQ 100 names, plus using those NASDAQ 100 index options. And our most recent addition, which we actually launched yesterday, is IWMI. So this is our NEOS Russell 2000 High Income ETF. So very similar on the equity side, covered call strategy, just substituting the reference index for the Russell 2000 and using those Russell 2000 index options to bring in income. So we're really excited about that one too.
Sounds like you got a pretty solid lineup there, Troy. What kind of ETFs can we expect from you in the future? Are you going to be sticking with options-based strategies?
Yes. So when you think about it, NEOS, all we're doing is option strategy. NEOS stands for Next Evolution Option Strategies. So for us, it's really important for our clients and for anybody looking at the space to know when they're thinking about option strategies to think about NEOS, because it's what we focus on. I know, as we were talking about earlier, how the space has grown so much. A lot of the new incoming products are really just kind of a bolt-on business for maybe a thematic player or somebody else in the space and saying, hey, the option space is hot, let's get a product out there. For us, it's all we focus on. So we have a number of other products in the pipeline that will get into registration soon, but they will all be option-based products. And if you think about, the asset allocation and kind of dividing up that, asset allocation, probably we want to get more out in the fixed income space. We do want to get more out in the equity space. We've grown with the S&P 500, NASDAQ 100, and as of yesterday, the Russell 2000. So we really want to keep slicing up that pie to make sure when someone's looking for some kind of option-based ETF that could pay monthly income in a tax-efficient manner, that they think of NEOS and they could find a spot for us wherever they're looking in the portfolio.
Hey, Troy, wrapping up here, we haven't talked about this, but it's an important part of the ETF space and really any investments. But what kind of fees are there when you're talking about these slightly more complex strategies?
Sure. No, it's a great question. So when the lowest fee we have is on CSHI, that's 38 basis points. BNDI is at 58 basis points. And all three of the equity products, SPYI, QQQI, and IWMI, are all at 68 basis points. So overall, relatively low fees, and they slot right in with, everybody else in the space for the most part. From what we've heard from advisors and clients, they're more concerned to make sure that they have that kind of total return performance to justify any fees in the space nowadays.
How do you guys plan on standing out in this space? I mean, the ETF space in general is obviously huge, diverse. There's a few dominant players, but there's a lot of boutiques out there. But in the options space, the kind of stuff that you're doing right now, there's also a lot of competition. How are you guys standing out?
No, of course. I think it's really, I always tell people starting a new ETF is difficult in itself, and getting to scalability is very difficult. So for us at a startup, it's probably 10 times harder. So I think for the team at NEOS, it's just telling our story, giving our background of what we've been doing in the space for a long time, and talking about these option-based ETFs. So I think it's really just getting out there and letting people know that we're here and that this is what we focus on in the marketplace. which is really important for us.
Well, fantastic. We're going to have to leave it there. Troy, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Want more analysis and expert opinion on the world of ETFs? Make sure to tune in to Exchange Traded Fridays, available wherever you get your podcast.